The Federal Reserve just changed one number and your credit card payment went up $87 this month. Your savings account that was earning nothing is suddenly paying 5%. And your coworker just got laid off. All from one number. Let me show you how this works and why you're probably doing everything backwards. My name is Brad, and I once tried to explain interest rates at a party and cleared the entire room in under 3 minutes. And if you think the Fed controls way more of your financial life than you realize, hit that subscribe button because we need to talk about this. Today, I'm going to explain the Federal Reserve in a way that actually makes sense. No fancy economics terms, no confusing charts, just the truth about how they're either handing you free money or taking it away. And why most people do the exact opposite of what they should do when rates change. Here's the thing. The Federal Reserve sounds boring. It sounds like something you don't need to understand. It's just some building in Washington where old people in suits make decisions that don't affect you, right? Wrong. Dead wrong. Every single month, your financial life is being shaped by the Fed's decisions. Your mortgage rate, your credit card interest, your savings account returns, whether you have a job next year. All of it comes back to one thing, the interest rate the Fed sets. And here's what makes me frustrated. Most people have no idea how this works, so they make the worst possible financial decisions at the worst possible times. They borrow money when rates are high and hoard cash when rates are low. It's completely backwards, and it's costing them thousands, sometimes hundreds of thousands of dollars over their lifetime. Let me explain this with an analogy that actually makes sense. The economy is a party, and the Federal Reserve is the host. They only have two tools to control this party. A gas pedal and a brake pedal. That's it. They speed things up or they slow things down. Low interest rates are the gas pedal. When the Fed lowers rates, they're spiking the punch bowl. They're making money cheap. They're basically saying, come on everyone, drink up, borrow, spend, take risks. And people do. Because when money is cheap to borrow, everyone borrows. When rates are low, houses get expensive because everyone can afford a bigger mortgage. Stocks go up because companies can borrow cheap money to grow. New businesses start because loans are affordable. Everyone's buying stuff. The party is raging. Everything feels great. But here's the problem. When everyone's drunk on cheap money, prices go up. That's inflation. Too much money chasing the same amount of stuff. Your groceries cost more. Your rent goes up. Your car insurance increases. Everything gets more expensive. The party got too wild, and now you've got a hangover. So what does the Fed do? They hit the brakes. They raise interest rates. Hard. They take the punch bowl away. They make money expensive to borrow. The party stops. And it stops fast. When rates are high, everything reverses. Houses become unaffordable because mortgage rates are through the roof. Stocks go down because companies can't borrow cheap money anymore. Businesses stop growing. Some start laying people off. The economy slows down. The hangover is cured, but now the room is empty. That's a recession. This is the only game the Fed plays. Speed up the party or slow down the party. That's it. And understanding which mode they're in changes everything about how you should handle your money. Let me show you exactly how Fed rate changes hit your actual life. Not theory, not economics textbook stuff. Real impacts on real money. Because this is where most people mess up. Impact number 1, your debt. Specifically, any debt with a variable interest rate. Credit cards are the big one. Most people don't realize that credit card rates are tied to what's called the prime rate, which moves with the Fed rate. When the Fed raises rates, your credit card interest goes up within weeks, not months, weeks. Here's a real example. In March 2022, the Fed started raising rates. They were at basically zero. By July 2023, they had raised rates 11 times. The average credit card interest rate went from 16.3% to 24.6%. That's an increase of over 8 percentage points in less than a year and a half. Let's say you have $8,000 in credit card debt. At 16.3% interest, if you're paying $200 a month, you're paying $154 toward interest and $46 toward principal in that first month. At 24.6% interest, you're paying $164 toward interest and only $36 toward principal. Over a year, the difference is massive. At the lower rate, you'd pay down about $1,200 of principal. At the higher rate, you'd pay down only $800 of principal. Same $200 monthly payment, but $400 less progress because of the Fed's decision. And here's what most people don't realize. This happens automatically. You didn't do anything wrong. You didn't miss a payment. The Fed just made your debt more expensive. And if you're not paying attention, you're suddenly trapped in debt that's growing faster than you can pay it down. Impact number 2, housing. This is huge. When the Fed raises rates, mortgage rates go up. And when mortgage rates go up, houses become unaffordable fast. Let me show you the math. In January 2022, the average 30-year mortgage rate was 3.2%. On a $400,000 house with 20% down, that's a $320,000 loan. Your monthly payment would be about $1,380. By October 2023, mortgage rates hit 7.8%. Same $400,000 house, same 20% down, same $320,000 loan. Your monthly payment? Now it's $2,280. That's $900 more per month, almost $11,000 more per year for the same exact house. Here's where it gets really interesting. This creates what people call golden handcuffs. If you bought a house in 2021 with a 3% mortgage, you're locked in. You can't sell and buy another house because you'd have to get a new mortgage at 7%, so you're stuck. Even if you want to move for a better job, even if you want to downsize, even if life changes, you're trapped by your low rate. This is why the housing market freezes when rates go up. Nobody wants to sell because they'd lose their low rate, and nobody can afford to buy because the new rates are too high. The market just stops, and this is all because of the Fed. Impact number 3, jobs. This is the one nobody talks about, but it's the most brutal. When the Fed raises rates, they're trying to slow down the economy. And you know what slows down an economy? Unemployment, people losing jobs. The Fed has literally said this out loud. Jerome Powell, the Fed chair, has said that to fight inflation, they need to increase unemployment. Let me say that again. They are intentionally trying to make people lose their jobs. That's the brake pedal. That's how they slow down the party. When interest rates go up, businesses can't borrow cheap money to expand. So they stop hiring. When they stop hiring, people who are looking for jobs can't find them. When business slows down, some companies start laying people off to cut costs. This is all part of the Fed's plan. According to Fed projections from 2023, they expected unemployment to rise from 3.6% to 4.6%. That doesn't sound like much, but that's about 1.5 million people losing jobs on purpose to cool inflation. Now you might be thinking, Brad, this sounds evil. Why would they do this? And look, I get it, but here's their logic. If inflation stays high, everyone suffers. Your money becomes worthless. Prices keep going up. Eventually, the economy crashes anyway, but worse. So they're trying to cause a small amount of pain now to prevent massive pain later. Whether you agree with that or not, it's happening. And it affects you. So you need to understand it and adjust your strategy. Here's what changed everything for me. It was 2021. Interest rates were at historic lows, like basically zero. I could get a mortgage at 2.8%. I could get a car loan at 1.9%. Money was the cheapest it had ever been in my lifetime. And you know what I did? Nothing. I saved cash, I paid off debt, I put money in savings accounts earning 0.1% interest. I felt good about being debt-free and having cash in the bank. I thought I was being smart. Then rates started going up fast. By 2023, mortgage rates were over 7%. My savings account was finally earning something about 4.5%. And that's when I realized I did everything backwards. In 2021, I should have been borrowing as much fixed-rate money as I could. A mortgage at 2.8%, that's free money. Inflation alone would make that loan cheaper over time. I could have invested the borrowed money and earned way more than the interest cost. But I didn't. I was scared of debt. So I missed the opportunity. Meanwhile, people who took out mortgages in 2021 are now locked into rates that are less than inflation. They're essentially being paid to borrow money. And I'm sitting here with cash earning 4.5% while inflation is still above that. This is when I learned the most important rule about the Fed. Don't fight the Fed. When they're pushing rates down, that's your signal to borrow. Lock in cheap money. When they're pushing rates up, that's your signal to save. Get paid for holding cash. But most people do the opposite. When rates are low, they're scared to borrow because debt feels dangerous. When rates are high, they start borrowing because they need the money and don't realize how expensive it is. Let me break down what you should actually do in each scenario. When rates are low, debt is king. This is when you want to borrow money, but only for good reasons. A mortgage at 3%? Absolutely. Lock that in for 30 years. A car loan at 2%? Sure, if you need a car and you invest the cash, you would have paid. A business loan at 4%? If you have a solid business plan, yes. The key is only borrow at fixed rates. Lock in the low rate so it can't change on you, and only borrow for things that will go up in value or make you money. A house, education that increases your income. A business, not stuff that loses value, like cars or furniture, unless the rate is so low it's basically free. When rates are high, cash is king. This is when you want to save aggressively. High-yield savings accounts are suddenly paying 4% to 5% with zero risk. That's free money for doing nothing. You should be maxing out your emergency fund, building up cash reserves, getting that risk-free return. This is also when you should be paying off variable rate debt like crazy. If your credit card is charging 24%, pay that off immediately. That's a guaranteed 24% return on your money. You're not going to beat that in the stock market. Kill that debt, and if you have fixed-rate debt at low rates, don't pay it off early. Keep that cheap debt. If you have a mortgage at 3%, don't make extra payments. Invest the extra money instead. You'll earn more in the market than you're paying in interest. Here's the bottom line. The Fed controls the cost of money. When they lower rates, money is cheap. When they raise rates, money is expensive, and your financial strategy should flip completely based on which mode they're in. Right now, in 2025, we're in high-rate mode. Rates are still elevated even though they've started coming down slightly. This is a cash moment. You should be saving money in high-yield savings accounts. You should be paying off variable debt. You should be very careful about borrowing money at these rates unless it's absolutely necessary. If you have credit card debt, attack it. Pay it off as fast as you can. The interest rate is probably over 20%. That's killing you. Every extra dollar you can find should go to that debt until it's gone. If you're thinking about buying a house, be strategic. Don't buy because you feel pressure. Wait for rates to come down if you can. Or be ready to refinance when rates drop. Don't lock yourself into a 7% mortgage if you can avoid it. If you have to buy now, plan to refinance in a couple years when rates hopefully drop. If you have savings just sitting in a regular checking account earning nothing, move it. High-yield savings accounts are paying 4% to 5% right now. That's the best risk-free return you've had in over a decade. Take advantage of it, but here's what you need to remember for the future. When the Fed eventually lowers rates again, and they will, your strategy needs to flip. That's when you borrow. That's when you lock in cheap fixed-rate money. That's when debt becomes your friend instead of your enemy. The problem is, most people don't understand this cycle, so they borrow at the worst times and save at the worst times. They fight the Fed instead of working with the Fed, and it costs them massive amounts of money over their lifetime. There's an old saying in investing, don't fight the Fed. It means that when the Fed is pushing rates in one direction, you should adjust your strategy to work with that direction, not against it. If they're raising rates, play defense, save money, pay off debt. If they're lowering rates, play offense, borrow cheap money, invest aggressively. The Fed is the most powerful force in your financial life that you have no control over. You can't change what they do, but you can change how you respond. And if you respond correctly, you can use their decisions to build wealth. If you respond incorrectly, you'll struggle your entire life wondering why money is so hard. Start paying attention to Fed announcements. You don't need to become an economics expert. Just know, are rates going up or down? That tells you everything you need to know about whether you should be borrowing or saving. And here's the thing that makes me frustrated. All of this information is public. The Fed announces their decisions, the news covers it, but nobody explains what it actually means for regular people. So everyone just keeps doing what they've always done, regardless of whether it makes sense in the current environment. Don't be that person. Be the person who understands the game, Be the person who borrows when money is cheap and saves when money is expensive. Be the person who uses the Fed's decisions to your advantage instead of being a victim of them. The economy is a party. The Fed controls the party, and you need to know whether they're spiking the punch or taking it away, because that determines everything about how you should handle your money. Watch my next video where I show you exactly which high-yield savings accounts to use right now and how to set them up in under 10 minutes.